All right, let's jump right in. Today, we're breaking down a really sharp analysis from BGVC on Circle's latest earnings report. Now, on paper, it looked like a massive win, but in reality, the stock got crushed. So we're going to figure out exactly why the market took one look at those headline numbers and just said, no thanks.
So this is the big question, right? The central mystery. Circle's Q3 2025 earnings came in, they beat what all the analysts were expecting, so why in the world did the stock price just fall off a cliff right after the announcement? It doesn't make sense, and that's the puzzle we're here to solve.
And here are the two numbers at the heart of the confusion. I mean, look at this. On one hand, you've got a staggering 202% growth in net income. That should be party time, right? A huge win. But then, on the other hand, the stock gets hammered with a 12% drop. These two facts just do not seem like they belong in the same story.
To really get what's going on, we have to dig into that gap between the flashy headline numbers and the market's, well, brutal reaction. We're going to peel back the layers of this report and see what the really sophisticated investors saw that maybe a lot of other people missed.
And this brings us right to the core of it all, unpacking what this BGVC analysis calls paper wealth. We've got to do a little financial forensics here, look inside that big, shiny net income number, and figure out how much of it is real, sustainable cash, and how much of it is, well, something else entirely. Now this is where the story really gets interesting. Check this out. Out of the $214 million they reported in profit, only about 38% of it, just $81 million, actually came from Circle's core business operations. The rest of it, over 60%, that came from one-off accounting items, things like a change in debt value and a big tax benefit. That is not income you can count on next quarter. Let's put a hard number on it. A massive $109 million, more than half of their entire reported profit, wasn't actual cash from selling things or providing services. It was just paper profit created by accounting moves, and for any serious investor, that is a gigantic red flag.
You know, this practice actually has a name. It's called financial polishing. And no, it's not illegal. It's more of an art form, using the accounting rules to make your company's performance look way, way better than it actually is. And frankly, Circle's Q3 report is a textbook case.
And here's another dead giveaway for investors who know what to look for. Whenever you see a company's operating cash flow, that's the real hard cash the business is generating, is way lower than its reported net income, you know something's fishy. It means those big profit numbers aren't actually turning into cash in the bank.
So, okay, the earnings quality was pretty low. We get that. But that's only half the reason for the crash. Now we have to talk about what the market was afraid of. See, investors weren't just looking at the last 3 months. They were looking forward, at one single giant headwind barreling straight for the company.
And this chart, wow, this chart just says it all. A stunning 96% of Circle's entire revenue comes from one thing: reserve income. That's just the interest they make from holding the huge pile of cash that backs their USDC stablecoin. When almost all of your money comes from a single source, you are incredibly vulnerable.
And vulnerable to what exactly? Well, that income is tied directly to interest rates. And if you look at the Fed's own projections, the path for interest rates is pretty clear. It's down. Every single time they cut rates, it directly squeezes Circle's main moneymaker.
So here's the bottom line on this point. The market selling off the stock wasn't some crazy overreaction. It was completely logical. It was forward-looking. Investors saw that falling rates were going to crush the company's main profit engine, and they priced that risk in immediately.
So the market's reaction makes total sense, but only if you're looking at the company's Circle is today. And this is where the BGVC analysis gets really, really interesting. It argues that the market is being short-sighted because it's ignoring the business Circle is becoming. The whole thesis is that we need to see Circle as two totally different companies hiding inside one corporate shell.
And here's how they break it down. On one side, you've got what the analysis calls FloatCo. This is the old business, the one that makes 96% of its money from interest. It's vulnerable, it's low quality. But then there's PlatformCo. Sure, it's tiny right now, just about 4% of revenue, but its growth is an explosive 2,800%. That right there is the real future of this company.
This chart really puts it all into perspective, doesn't it? That bar for FloatCo is huge. It's a giant. But the real story, the one to watch, is that tiny little highlighted bar for PlatformCo. It might be small today, but with that kind of insane growth rate, it could be the real engine of value for Circle just down the road. And there's another absolutely huge piece of the puzzle the market seems to be ignoring: regulation. The passage of the Genius Act was a total game changer. It created a clear legal framework for stablecoins like USDC, and, this is critical, it protected them from being labeled a security. That is a massive deal. It means they avoid mountains of rules and costs, and it gives them a huge, government-approved competitive advantage, a moat against their rivals.
Okay, so let's pull all these threads together now and reframe what Circle's really about. We've seen the low-quality earnings, right? We get the market's fear about interest rates, but we've also uncovered this hidden, super high-growth business and this incredibly powerful regulatory shield.
And the BGVC analysis just nails it with this quote: "CRCL's true value is in the platform, not the float." You know, in other words, the market is staring at a melting iceberg while completely missing the rocket ship that's being built right next to it.
So the big takeaway here is a whole new way to think about Circle. First, you have to admit the Q3 earnings report quality. Second, you have to understand why the market is justifiably scared of rate cuts. But third, and this is the most important part, you have to mentally split the old, vulnerable FloatCo from the new, high-growth PlatformCo. And finally, you have to factor in the huge value of that new regulatory moat.
And all of this leaves us with one final, pretty provocative question. As the entire market stays glued to every tiny move in interest rates, are they completely missing the signs of what could be the next giant in financial technology?